Hi, Uncle Fu. Good afternoon. Welcome, everybody. If you're here in the live stream, just say hi so that I know you're here. In the meantime, I think Terence is actually also logging in now. So let's just give everybody some time as we settle down into the stream room. And then we will get in touch with the live sharing today on Sea Ltd. Good afternoon, everybody. And if let's say, for example, if it's the first time that you're actually in the room itself, you will see that your comments will show up as this. It will be shown as a Facebook user. So do remember that you need to actually enable the StreamYard to actually view your profile for Facebook so that we will be able to see your profile, for example, like how Uncle Fu's profile will be showing up. All right. So do remember to enable StreamYard to view your profile. Hi, Jocelyn. Hi, Jason. Hi, Jonathan. Right, good afternoon here. Hope everybody is enjoying your weekend. And I certainly did enjoy mine. And I was looking at the poll, and I was looking at Sea Ltd. And this morning, as I was collecting myself from the bit of hangover, I was able to come to a conclusion in terms of what we needed to share with everyone for the Sea Ltd's analysis here. All right, it's very I would say it's a continuation in terms of the theme that we had for Fastly since the last week, and I do hope that the sharing today will be useful for everybody. And also, if they say you do find that your friends or yourself, or you believe that any of your friends will be able to enjoy or learn more from our sharing today, you can also click on the share or click on a viewing session, like a viewing party in Facebook, so that your friends can also view it together with you live. All right. All right. Hi, Josephine here. Right. Let's just give it a few moments as we wait for Terence to be in as well. In time, let me just get ready for my slides as well. Right, so if there's any of you here who are here first time, so you can also say hi so that we know, and we will be able to say a personalized goodbye, hi to you as well. And for those of you who have been our loyal viewers here, like Josephine, Uncle Fu, I'm sure I will miss out some of you guys as well. Thank you for actually investing your time into the weekend session together with both of us, myself and Terence as well. I think Terence has informed me that he will need a little bit of time to actually come online, so I will start the session straight. Let's just give it a while more, give it a while more for everybody to settle down. All right, because this is a very short notice that we're getting started here. Hi, Christine here. Hi, Christine. And let's just give it a while, a little bit more time. Hi, Shinyi. Hi, hello, hello. I hope everyone has had your lunch or your lunch break. I haven't had my lunch. It's been a busy day. Yeah, but I'm going to go for my late lunch after this. All right. So today's session is going to be a very, very crisp and short one because it's going to be able to bring out very important concepts that we will have to reinforce as we conclude the October special for the IMP Stock Nit-Picking before we review and decide again how we're going to deliver the format again for November as myself and Terence come together and coordinate again to decide again when it comes to November whether we are still able to deliver the session, and as well as the fact that if we are able to do so, what will be the style or the format we'll be doing. Because I do believe that while sometimes our viewers would like to have trade ideas that we can share, sometimes the choices of the stocks that is being chosen don't necessarily allow us to actually structure a possible trade or structure a trade that we feel comfortable to share. All right. All right, without further ado, I'm just going to start the session out right here. I think we won't hold everyone up. Okay. All right, hi, Terence. Hi, Terence V. All right, so I think Terence is still getting ready, so I'm just going to start the session here. Right, good afternoon. Speak of the devil. Hi, Terence.
All right, hello everyone. Okay, Jeremy, take it away. Let's get started.
All right, then. Okay. So before I commence the sharing today, I need to emphasize that the sharing today is purely for educational purposes. So any comments are purely our personal take and is not to be construed as a financial advice. All right. So if you would like to take on any trades or if you have any positions on these companies or counters that you have in your portfolio, please do your own due diligence before you make any adjustments or any new trades. If you need advice, please take out your own financial advice before you do so. All right. So we go straight into the company we'll be looking at today, which is Sea Limited. This is the 1 year daily chart for Sea Limited. So you see that 1 year ago it was trading at about $37, and the last high we saw is about $170, very close to $180. We are seeing a multi-fold jump. That is why I think we have a poll result whereby a lot of our viewers want to know what is our view on Sea Limited. All right, you have it here. This Sunday we'll be talking about Sea Limited here. Now, for those of you who do understand what is Sea Limited doing, Sea Limited is an internet company. Okay, it has 3 segments, and out of these 3 segments, we have digital entertainment, e-commerce, and digital financial services. Now, in the profile of the company itself, right, they mentioned that they have maximum revenue from their digital entertainment segment, whereby they have their G Arena platform, or some people call it Arena platform, which actually offers mobile and PC online games across the region, right? I would say actually call it internationally, and they also develop mobile games for the global market itself. They are actually the global leader in terms of esports, which is like electronic gaming sports. Okay, just think of it like whereby electronic gaming has developed a stage whereby it's already a sports, whereby there will be situations whereby a lot of different viewers will actually congregate at one time, and then we will watch the competition, similar to like what we have in Olympic Games. Yeah. So they also provide other entertainment content and social features like those live streaming, user chat, and online forums. And they are not just focused in terms of Asia, but they are majority of revenue is actually from Southeast Asia. Okay. Now, for this session here, I must bring across the emphasis again. When you listen to our review, because I'm not sure whether you've been with us for how long. Is it your first time here? Is it your 15th time here? Because this is the 15th episode of the Stock Nit-Picking here. You need to know, are you a trader, are you an investor, or are you unsure? Okay? If you're unsure, you need to be sure what is your choice, what is your style. If you're not sure, you have to know your style before you can take a decision. Now, if you're a trader, you're looking at something under a year, sometimes shorter, sometimes a bit longer. Some people will say that maybe 2 years is still a trader. But typically for an investor, we're looking at more than 1 year or more than 2 years. Okay, that will help you define the spectrum, the time frame that you can consider to take a trade. Okay, or to consider it a trade. Okay, you must keep this question in the forehead. You must keep this question, the first question you need to understand every time you review a new stock. Okay, so I'm just bringing and refreshing this question again, so in case some of our viewers are not very really thinking of this question every time they look at stock, because they're just chasing returns here. Okay, now here again we have the mini game, which is to count the colors. Okay, my slides are color coded. The headers are color coded such that if it's pink, it is my emotion towards that segment, that information I'm bringing across. If it's blue, it is also representative of my emotions towards that information I'm bringing across. Okay, so we're going to count the colors here. So pay attention to that. I will not be repeating the slides today like what I did last week. So pay close attention to that. All right. Right, let's start across it proper. Now, figures are taken from Morningstar numbers just this morning. So they are very fresh here. For Sea Limited, we have an excessive price X ratio. Excessive. Okay, we're seeing price book numbers 90 plus, we're seeing price cash flow numbers 500 plus, and price sales numbers 25 times. Price cash flow numbers 500 times. Does this sounds very familiar to you? The last time we mentioned something similar to this will actually be Tesla. Tesla, when we mentioned that, I think it was their price sales was close to $600. So imagine, for example, a company whereby they can only generate free cash flow, and they're telling me that, oh, based on the stock price now, I need about 500 plus years to make back the same amount of free cash flow they have. Okay, to me, this just makes ridiculous sense. How am I actually going to be able, like, to collect back this free cash flow based on the price I'm paying for the stock now. Right? To me, this is a no-no. But I'm just going to look through the numbers again to see whether there's anything else that can save this company from being eliminated just by this one very big red flag here. Now, okay, for price X ratios, price to something ratios, these are just one part of a snapshot in terms of financial analysis here. So they should always be looked in terms of relative sense. But when sometimes on isolation, they are so glaring, they're so such an anomaly. Like in this case here, we're looking at 500 plus into the price cash flow. You really have to wake up and look through again. Okay. All right. Next one. We're saying income. Where is the income? There is no income. Income is totally missing from the whole Morningstar numbers here. We're really seeing growth in terms of revenue for the last 3 years annualized. All right. Does it mean that there is no income? Does it mean that the income is not growing? We don't know at this moment. Okay. Question mark. This is a very big question mark here. And again, then we move on. The quick ratios, the current ratios, the interest coverage, they look very typical of a growth company. Okay. Why I say a growth company? Because if you see a growth company, you will see that because a growth company, you will never know underneath the growth company what is the equity structure. Are they going to be a debt structure? Are they going to be equity structure? Are they going to be a combination of the debt or equity structure? Do they take loans? Do they have preferred shares? You will never know because they will never say that all out. Do they have class A, class B type of shares? You will never know also. So these numbers, while they look healthy, it could be that, hey, they meet the numbers. They have a quick ratio of 1, they have a current ratio of 1, they can meet their short-term obligation. But interest coverage, they have a negative one, so they can't actually offset. They can't actually pay off their interest payment itself. Are we looking at a case whereby they need to continuously raise funds? I'm not sure. I'm not sure. We'll examine that further. Okay. Now, the company is not profitable. That is why there's no income. Period. Full stop. That's it. All right. For those of our viewers who have been with us for at least 10 episodes, you will know that usually by this point in time, I will stop the analysis of the company based on my own preference, based on my style. Okay. But I'm going to run through the whole train of thought for you to see where am I looking for in terms of this company, because there is another portion here similar to Fastly from last week where you can learn something from this company if you've gone through the whole train of thought here. Okay. Now, but Sea Ltd is not profitable now. Period. Okay, we are saying net margins is negative 39% as of this year in terms of June. So for every dollar that they try and sell, or rather they sell, they are making a loss of 40 cents. So I'm just wondering, like, what is the point of having a stock price that's actually running up so high? Like, is it even sustainable? Okay, so if you have a comment here in terms of why is it the stock price is actually running up so high, drop the comments here. Let me examine to see whether it makes any viable thought, whether it's reasonable here. We will examine that. You can leave a comment here. Moving along here. Now we see that in terms of net income here, examining the close look, taking a closer look at net income here, we see that it's not consistent. 2017 is negative 0.5, 2018 is negative 0.9, 2019 is negative 1.4, and then we're seeing trailing 12 months, we're looking at negative 1.1. Okay, it seems like it's just going down and going down and going down. And suddenly went up again. So are they really recovering so that they will have a case whereby they will have a profitable period soon? I don't know. But what I can tell you from the numbers is they have not turned profitable. Full stop. Okay? So the thing is that if I'm going to be paying $100+ for a company, I think the least I want to know is this company profitable now? Or how long can I expect this company to be profitable? Now, as I understand it, the Sea Ltd is not a company like Fastly that has already been established, like say, in the last 3 years. No, Sea Ltd has been established since 2010. All right, so as I look at it, they seem to have been listed in 2018. The research here, this research in this slides here, they are all done in like a quick 15 to 20 minutes time. So this is the real replicate of a train of thought you can have when you're looking through a company before you decide whether you want to put your funds in on a normal trading day where you look through Morningstar numbers. Okay, we're not going to do like what a fantastic report that you see very, very clear numbers, very bombastic numbers and charts and pie charts and all, and then you realize that, hey, this is a company that I don't need to do or I can do something about. But you don't know that an analyst actually took maybe 3 days to prepare that. No, they don't make sense. Because are you going to take 3 days to analyze a stock? Yes, you can. But do we really have all the time in the world to do that? No. For me, no. I only have 15 to 20 minutes for every stock I'm going to look at. And this is the amount of time I commit for sure, consistently for every week, whenever our viewers tell us that you have a stock you want us to look at. Okay, so in this 15 to 20 minutes time, I figured that, hey, Sea Ltd actually got listed sometime in 2018, around there. Number one. Number two, Sea Ltd seems to have been founded in 2010. Sea Ltd in 2010 until 2020 now has not been profitable. The net income has not seen positive numbers from what I've seen. Okay, so correct me if I'm wrong here. I might have missed out numbers, but I don't see a positive net income so far. Okay, and we're looking at in terms of the equity numbers here. When you buy into a stock, you're effectively becoming an equity owner. You are owning the equity portion of the stock. The assets minus the liabilities here is what you have, which is the equity part. In the event of liquidation, this is the remaining value that you have. And this is not a good sign here because I'm seeing an equity sign whereby, hey, 2017 I have a positive equity, 2018 I have a negative equity, 2019 I have a positive equity higher than 2017. And then now 2020 in the second quarter, I see a lower equity. Now, if you don't understand this, right, this is like, okay, imagine this. You park $1,000 into a fresh bank account. You put it into this account. Now, 1 month, the first month you open up your bank account, you see, hey, I see the $1,000 become $480. Okay. Now, then, and then the next month I see, hey, $1,000 become maybe $240. And then the following month you see $1,000 become maybe $1,100. And then the following month I see $890. Does this fluctuation makes you comfortable? I mean, there will be viewers here who will say that, hey, I'm comfortable with this because this is a growth company. I'm buying to the growth here. I'm buying to the next Google. I'm buying to the next Facebook. Sure. This is your prerogative, but this is not something I like because I'm in the stock market to make money. I'm not in the stock market for excitement. If I'm in the stock market for excitement, I can go to Marina Bay Sands. I can go to Resort World Singapore and I can have it faster. Right, so this is not something I like in terms of the equity fluctuation. Okay, moving along here. So you're also seeing a negative cash flow, which is what we mentioned earlier here. Now, free cash flow in terms of the numbers across the years has always been negative. Think about it this way. A company that has been around for 10 years and is still telling you every year we still do have free cash flow. If this company don't have free cash flow, that means there's no spare cash at the end of the year. What is the first thing they need to do? They need to raise funds. Which is true. Financing cash flow is always positive. They need to raise funds. They did raise funds. Okay, they did raise funds. Now the question to ask you is, 10 years after a company is founded, after the stock price has went from $20+ to $170+, can you still say that this company is an infant? Or are you going to say that this company is a teenager now? Or is this going to be a perpetual baby? You need to make the decision here. Okay. Now, of course, there will be people who say, I have mentioned before that Google took 17 years plus minus to become profitable, and they become the giant today. They want to invest in the next Google. Okay, sure. Are you going to be able to wait for the next 7 years if they really take the same amount of timeline for Google? 17 years, so 10 to 17 years. Are you going to be so sure that it's going to be the next 7 years that they will become Google? Can it be faster? If it's faster, sure. You have benefited. If it's longer, how long more? I don't know. But in the meantime, there will be other opportunities out there that we have already identified in our past examples. Sure, 1 or 2 of them. We don't need to identify so many. Just need to identify 1 or 2 of them consistently. As long as we keep trying, we keep finding. And if it makes sense, we park a little bit in terms of our funds that we are willing to invest into them, and then we can see the returns. Do I really need to be so what is that word? Focus on just this company because this company has been seeing an explosive return. When end of it, the outcome I want to is just to make money. I mean, for me, no. I think our viewers will have a different view. Okay. Now we're looking at the ratios here: price, earnings, price, cash flows, and price sales actually because there's no earnings. Price sales, price cash flow, and price book. Now, there's no 5-year average number because the company is only listed sometime in 2018. Okay. And you're seeing that if you take the numbers for current divided by the index, you're seeing that the price sales is 16 times the index. You're seeing the price cash flows is close to 70 times of the index. You're seeing that the price book is 96 times of the index. What it means to say is, for example, when you pay for the stock, you are paying for 15 times 16 minus 1, 15 times the excitement into the stock against other stocks in the index, because this stock is very hyped up by the other market participants. This is how I look at it. Okay, if I look at it in terms of cash flow, okay, you're overpaying by 68 times in terms of excitement. If you're looking at price book, you're overpaying by 95 times in terms of excitement. You will always be overpaying in terms of excitement for most of the time when you're in the stock market. But to overpay for 95 times is ridiculous, if you ask me. I mean, if like say, for example, if you're overpaying by say, we're looking at maybe numbers like 10 times. When your numbers are price book is like 11, or price cash flow is 11, price cash flow is 20, and then your average numbers are very close to that, sure, you can do that. Because we want to always be comparing against the 5-year average. Unfortunately, I don't have these numbers now because this company is so newly listed. Okay, this is so newly listed. And then I do anticipate that there will be our viewers who will say that, hey, this is a growth company. You can't be looking at it in the same way as a blue chip. Yes, you are right. We can't be looking at it the same way as a blue chip. But then the question to you is, does it matter if it's a blue chip or if it's a growth company? At the end of the day, you still make money. Again, the question is, does it matter if it's a blue chip or if it's a growth company? At the end of the day, you still make money. Okay. Now, at this moment in time, I just want to take a pause here. And consolidate the opinions that we have from our viewers here, because this I know, this stock is on the radar of a lot of people for the past year, and the comments I put out here is going to put me on the target board of a lot of people. Okay, so I'm not seeing the comments yet because I'm on the full screen here, so I'm going to go straight in, and I hope I have not had a contract put on my head for now. Right here, let's see here. Nothing. Everybody's so quiet. Everybody's asleep, or nobody who voted on the company actually is in here. Can I get a show of hands? Maybe a comment here. If you have voted or if you have positions in the company, just let us know you voted or you have positions, you're vested in the company. Leave a comment here, please. Thank you. Right, let me just take a quick water break.
All right, now, so help Jeremy out, everyone. If you have vested interest, okay, do it this way. If you are vested, that means you are in the stock right now. You would type vested. But if you are not in, then you can just put vested interest. Okay, that means you're looking to get in. Then put up the vested interest over here. Albert, curious about the technicals. Don't worry, I'll get there. Jeremy's up, and then when he's done, I'll come in. Jeremy, I think you have a question for Albert.
Sure. Okay, Albert, your question is, how do you think a good growth company ratio should be? Okay, and I think we have another question in terms of what is a reasonable PE ratio for a growth company provided that the company is profitable? Okay, this too, your essence of the question is, what is a good growth company's ratio? Okay, what is a good growth company's ratio? Okay. I will tell you very upfront here. I don't have an answer for you. Okay? I don't have an answer for you. Because end of the day, the people who tell you that a good growth company is going to have this ratio, because so and so forth. Okay? By the templated answer, I cannot say that they were wrong. But the question is, the people who were able to deliver the financial statements, the people who were paid large sums of money, we're talking about the CFOs, the chief financial officers, the accountants, right, who were able to do this statement so that they present the best side of the company to you, they are not paid this amount of money for nothing. Okay? So your prerogative should not be what ratio is good. Okay, let me rephrase myself. Your choice of learning, your choice of needing to know should not be focusing on what is a good ratio to have. Okay, but you need to switch it, change your thinking process. What is the red flag to avoid when you see in a company? When you see a red flag, avoid. The more red flags you see in a company, avoid more, avoid more, avoid more. So this is what we have been doing for our viewers. Every time we see a company that they tell us, or every time we review a company, we tell them, okay, this is a red flag we're looking. This is a red flag we don't like. Okay, not even the companies that we find that, hey, they are profitable in the end. For example, IIPR that we did previously, cannabis, REITs, simple business model, 3 years in the business, already profitable. And I think it ran up from $70+ to $100+ in terms of the stock price when we last shared it in July. They didn't have a very good in terms of the fundamentals across board. It is not all green. It is not all blue. They also have some issues, if I'm not wrong, in terms of their debt equity. But those were small problems. Those are small problems that made us reconsider that company. But overall, they are okay for us to take a chance, take a calculated risk in terms of the company here. Okay, let's see. Why do some people say price to sales ratio is the expected growth rate? Don't seem to understand it mathematically. For example, PS ratio, price to sales ratio, 48 means that people are expecting 48% growth. Sure. Okay, Albert, let me chop it up for you. Okay. Now, here at IMP here, we teach you not just the book style. We teach you the way that you can think very simply so that you can immediately digest and relate it to what you can understand. Okay, so we don't just teach you the book style, we teach you how you can immediately apply. Now, if you can recall what I mentioned earlier when it comes to the, let me go to the slides here. All right, I'm just going to use this, okay? Now, you see, price sales, okay? Price sales is 25 times. Okay, now if, let's say, for example, today you're one of the investors and your basis for your decision is, I want to pay the same like for like for sales numbers. If the sales is $10, I'm going to be paying $10 for the stock, okay? But now the stock is worth $20. So price sales is 2 because 20 divided by 10 is 2. So overall, I'm overpaying by $10 for the sale portion because I'm using sale as a basis. Meaning to say, in terms of my belief, I am pricing in at 100% or $10 enthusiasm and expectation. This is an expectation into the price sales portion. Okay. Now you must understand that the stock market, right, does not fully operate on numbers. It does not fully operate on the business numbers, the fundamentals, the business profits. No, it does not. If it does, if it just fully operate on business profits, right, today we will not be talking about Sea Ltd because Sea Ltd is not even profitable now. But the stock market operates under people's expectation in the future. The market as a whole believes that this company in the future will be able to become profitable. Okay, so we have that is why when they say that, based on your question, when they say that price to sales ratio is expected growth rate, right? What they're trying to tell you that this is the expectation. This is the expectation moving forward. Okay, if you want to go technical, you want to go into the nitty-gritties, how you want to determine the expected growth rate. Yes, there is a school of thought for that. You can go into the exact definition and go into that. But to understand this in a very nutshell, what they're trying to tell you is this is their expectation moving forward. Okay, right. So we have a question asking in terms of the intrinsic value for C. We will be going to that because there's a slide on that here later. And just a reminder, because this is the first time you are into our sharing, you need to enable the StreamYard profile, StreamYard link, so that we can see your link, your name, so that we can answer you personally. Okay. All right. So I'm going to continue with my slides here.
Jeremy, right, let me just cut in over here.
Sure.
I think there was a question about PE ratio. I just want to bring out Eric over here. Eric is probably going to fire me if I'm going to use PE ratio as a metric to measure growth stock, because for growth stock over here, there is no, there is really no, how do you say this, measure of what is a correct PE ratio, because as long as the growth of the company continues, and it depends also on the pace of the growth. So it justifies the high PE ratio, because PE ratio basically just means the stock price divided by the earnings of the company. So one, we know that when it comes to growth companies, they probably have very little earnings, and they are probably in the phase of trying to fight very hard to become profitable, or actually to start growing their earnings. Okay, this is going to take time. That's why you always find that growth companies over here, when you try to measure it from a PE ratio standpoint, it doesn't really make a lot of sense at all. Okay, it really doesn't. Okay, but however, we can still make use of PE ratio to generate what we call a quick overview. Okay, later on when I go to my charts, okay, I'll quickly display this part again. Honggan, if I don't bring it up, please remind me how PE ratio can be quickly accessed over here, even for a growth company. Okay, because when you want to use PE ratio when it comes to growth companies, I think the only measure that you can tell it's really from a market standpoint. That means based on what the market is putting out on a PE ratio for a growth stock. Okay, are we seeing a bubble-like situation or not? Yeah, okay, all right. So I will show all of you how we're going to do it later on when I get to the chart. So I'll just let Jeremy finish his fundamental analysis first. Okay, Jeremy, over to you.
Thank you, Terence. Yeah, so let me just make sure that, okay, yeah. All right, so we also use assisted screening here. This is taken from the Simply Wall Street website. All right, so if you're interested, you can also go in and register for a free account here. Okay, so under the Simply Wall Street website here, you can see that this is for Sea Ltd. Okay, and we see that the REITs, they say is actually high in terms of high volatile stock prices, and that shareholders has been diluted. And they say that, oh, earnings are actually forecasted to grow. Okay, now in terms of these summaries here, I don't pay too much attention in terms of some of the REITs that they won, but I use them for some key aspects. Okay, some key aspects. A little bit of hint, we have already mentioned it last week, and I did mention it, I think, at least 2 more times in the last few sharings that I did before. Okay, I'm gonna go there. Now, but for some of you who like to have this value, this fair value here, this is taken from Simply Wall Street here. Simply Wall Street feels that the fair value for the company is around $125 range, and the company is currently trading at about $162. Okay, this is their view. This is how they calculated. They have a formula here. If you like to, you can actually go into the site and go and see how do they calculate it. They actually publish their formula here. Now, the question I need to ask you before I start the next segment here, which I will assure you will blow your mind, is when will you sell a company stock? Can you tell me in your comments here, when will you decide to sell a company stock? All of the possibilities. If you own a company stock, okay, when will you decide to sell it? I need some participation here so that I can get the learning experience for you to maximize it. Because this sharing session, this Stock Nit-Picking session is not me saying an inner monologue. This is a two-way traffic. I'm sharing you my thinking process so that I can engage your train of thought here, and we can help each other to, number one, I can help to sharpen your thinking process here. I can also try to translate some of them and also clear your doubt when you have some of them here. So when will you sell a company stock? Can I get some response, please? Okay, we have Christine here says when there's profit. Yes, when there's profit here. What else? What other scenarios when you will sell a company stock? Can I get some response, please? We have some more. Uncle Fu, Josephine, maybe you can give it a shot. Don't have to be shy. There's no shame in being wrong. There's only shame in being wrong and you not trying to learn. Okay? Because myself, I have been wrong a lot of times when I ask questions to Terence, and I feel absolutely silly. But thinking back, I feel absolutely empowered. Okay? So yes, let's see. Yes, we have when prices are about to decline here. Josephine, yes, that is correct as well. We also have a more technical one. We have there's about 20% profit using Fibonacci. Yes. We also have when Xinyi, when it says company growth is about to deteriorate. Yes, this is what happened. Firstly, last week we said they dropped in 20% because they were forecasted to drop in terms of their moving forward forecast. Yes. Okay. So we also have some of you who say they're not sure. We're not sure as well. Okay, now you are all right in terms of when you will sell because you want to take profits. Okay, you want to take profits here. Okay, when the price is about to decline and when the growth might deteriorate. Now, keep those response in mind. Okay, keep those response in mind. I'm going to show you something. This is the insider selling tracked by Simply Wall Street. Again, this is tracked by Simply Wall Street. Okay, we have viewers asking us where did we get this? This is not some privy information that we got from some shady sources. No, this is from Simply Wall Street website here. In the last 3 months, we have seen some shares being sold in total value about 91.6 million. Okay, if you talk about the full capitalization of the company, that is not a lot. That is really not a lot. Okay, but I want to let you see the price that they were sold at. Okay, under there were 3 different transactions here on the 25th of August. The price sold was respectively in the regions of $151 and $149. Let's just call it $150. Okay, and they were by these 3 different groups: Superclass Ventures, Carry Group, Paxton Ventures Limited. Now, if you ask me, my view is that they are taking a profit. This is my view. They are taking profits. Okay. Now I'm just going to expand on that one train of thought. This is what I had in my mind when I was looking through the whole screening today. Okay. Frankly, I look at Morningstar. I tell you this stock is something I would never look at. But as I look at Simply Wall Street, this is something I need to let the viewers know. Because if they see this next time, at least they have an additional layer of perspective they can think through before they take a trade or before they manage a position here. Okay. Now you think about it this way. Today, if let's say I have a company that I invested in, company XYZ, okay, I firmly believe that this company for sure will keep going up like a rocket in terms of stock prices. Okay, will I take profit at any point in time? If my main aim is to maximize my profits, maximize my gain from the stock market. If I am a rational investor, okay, and my main outcome I want to is to maximize profit, my answer will surely be no profit taking until I'm sure that, oh, growth will drop. Oh, I'm sure that the price will drop. Then I sell. Then I take a profit. Or when I realize that, hey, there is a better opportunity out there, I will sell. This is how I look at it. Okay. But these companies, these 3 groups, they sell it at $150+. These, to me, as I read it, gives me the indication that, hey, they still are big shareholders into this group, into Sea Ltd. But even themselves, they also need to be accountable in a certain sense, or they are not so sure, not so 100% certain that, hey, the stock prices here will always stay above $151. Let's take some profit here. Then we see again. Okay? You couple these with your views earlier, where we see from Morningstar numbers. $500+ in terms of some ratios, excessive ratios in terms of comparison against the indexes, okay? And then you link it to what we see last week. Firstly, immediately when the projected numbers moving forward for the next 1-2 years is expected to drop, okay? The stock dropped 30% in the pre-trading for 1 day. Okay, now I'm going to ask you this question. Fastly's numbers, was it worse? Was it as inflated in terms of enthusiasm than Sea Ltd? No, Sea Ltd is more inflated in terms of enthusiasm than Fastly. Can there be a chance that, they say that, okay, we are expecting the forecasted revenue or the forecasted net profit to not be realized so soon. And then, hey, we see another 30% drop from $162 or more or less. I don't know. Are you willing to stomach such a change? Are you a trader or investor? Okay, so if you still do remember the significance of those questions, then I remind you, are you a trader or investor? if you're an investor, when you see such numbers, such in terms of fundamentals numbers, you really have to think through, can you sleep well at night? Is this a number? Is this a portion of your portfolio that you can risk? Are you even willing to risk it? Or is there better opportunities out there? Okay. For me, I feel that when I look at this kind of company, there is always better opportunities out there. Not in terms of upside risk. Not in terms of upside potential, but in terms of managed downside risk. Okay, I always look at manage the downside risk. Okay. So here, for people who are asking, what is the intrinsic value? Okay, I think there was a question earlier. Let me try and zoom in. This is the book value taken from Thinkorswim platform. It is negative. Negative 71 cents. Okay, so it's very clear to me. I need to ask you this question here. Why are you in the stock market? Are you in the stock market for excitement? If you are in the stock market for excitement, there are cheaper alternatives in Sentosa and in the southern part of Singapore or in wherever you are. I think in Asia, we don't have a lack of this casino, if you don't understand what I'm talking about. But if you're in the stock market to make money, not once, not twice, but consistently, and not just to make money one time and then maybe to run into a breakdown, but to make the money comfortably such that you don't have to worry whether you have to lose it again, then personally, my take is, this is a stock I'm not going to look at. Okay. Terence, is this a stock that you will look at?
I will share later. I'll share later because there is actually a trade window. I won't invest in the stock, but I might actually trade it. But it has its own difficulties when it comes to trading the stock. So I'll highlight it when I get to the technical side later on.
Sure.
So definitely not investment stock because all of you should know by now I'm a contrarian. So which means I don't, I look for where the probability is higher. So right now there's definitely lesser rewards on the near term and a lot more risk. So for this reason, it doesn't feel good, and never buy into a money losing company. You can talk, you can talk all about the growths, and I think Uncle Fu brought it up as well. Even in the sea of gaming itself, they are already starting to see competitors. And if you want to leverage on their next biggest brand, which is probably Shopee, yes, Shopee is stealing a lot of traffic from perhaps Lazada. Many resellers or many stores are setting up on Shopee itself. But if you look at the promotions that Shopee is running, it is pretty much doing what Grab is doing. That means it's trying to gain market share at a loss. So yes, they are gaining market share, but as a whole, Shopee itself is still losing money. So, they're doing it at all costs, which means if Shopee was really profitable, if their online gaming was really profitable, the company should have already turned green. Okay, because just this year alone, okay, if you look at it, just this year alone, with the online, with the pandemic pushing people online, they should be able to turn green. So if they're still not green, then it just shows you moving forward what kind of growth perspective it has. Okay, I'm just sharing from, you realize I'm not heavy on fundamentals, which means I have not gone into this company as in-depth as what Jeremy has said. Him mentioning the numbers just now is the first time to me, but I'm just looking at it from a broad perspective in terms of experience and how the business looks like. So one, it faces a lot of competition. Two, in the markets that it is fast gaining market share, it is still yet to find a way to turn profitable. So if it has gained so much market share in the last couple of months and it still can't make a profit, then what's it going to be like moving forward? Yeah, okay, really, what's it going to be like moving forward? And then, do you want to stay for the long haul? Because a lot of people, trust me, a lot of people are saying, Terence, how much money have I made from Amazon? Okay, then the question is this: how do you make this money? Do you make this money because you have invested in Amazon only in the last 1 year itself? Or you have been a vested investor of Amazon for the last 5 years? How do you make this money? Yeah, okay, so you should think of it pretty much for C as well. Because, if you are a vested investor, right, and the company is not profitable, right, is this the right time right now? Okay, is this the right time right now? or should you wait for it to start to go into a growth phase? Okay, a growth phase where it's actually profitable. Then maybe it can become the next Amazon. Yeah, maybe then you should spend that 1 year period to make the maximum profit you can. Yeah, okay, but right now, if it's not profitable with everything going green for it, everything is favoring for the company itself. If it still can't make if it still can't turn a profit, then something is happening. All right, and I'm not gonna get anywhere near it. But from trading, from speculation, then you are talking about a different ballgame. Yeah, Jeremy,
Yes.
back to you.
I agree that, yeah, Terence. So if let's say, for example, that is why I made the very, very clear distinction here. If you're a trader and you are not in the long haul, you're looking at taking snipes in terms of short-term positions because of the directional bias that you have, sure, do it in a way that you have a defined loss. Do it in a way that you are willing to accept the losses that you can incur and go for it. Because there is value here in terms of the lopsidedness of the company that we see. But you have to bear in mind that you are betting. I'm saying the word betting. You're betting against the market because everybody believes that this company is going to go up. That is why the enthusiasm is so high. Okay, so you must understand what you're doing. You must know what you're doing. Okay. Number two, if you're an investor, okay, and you don't know this thing, let me tell you first. When a company moves from growth phase to mature phase, again, when a company moves from growth phase to mature phase, a company's stock price will usually experience certain level of slowdown or decline because the growth is now priced in and such that the stock prices have to be lower, right? The growth is now priced in such that the stock prices is now be lower. The expectation moving forward has to be lower. So if you go in now where the price of the stock is at the growth phase, you are willing to accept the fact that when it moves to the mature phase and the stock prices take a hit or the stock prices don't move at all, and you're willing to have the funds move stuck in there, sure, go for it. Sure, go for it. Really, really. Because you see, when we see companies at this phase at such a bad shape in terms of financial numbers, okay, this is when the value can be there. I admit it, because this is when the value can be there. Now, my main intention here for the analysis is not just to find value. I'm finding value because I need to make money. I'm finding value because I need to make money. So my main intention is to make money. So if I can make money elsewhere, I have other stocks, I will go for them. I don't have to make it difficult for myself. Why do you need to reinvent the wheel? Don't have to. But if, let's say, for example, you feel that, okay, you want to park your funds, you want to park your portfolio into this company because you can accept the fluctuations, you can accept the long-term wait, and you are okay with it, you can hug it until you need to pass it on in the estates here. Yeah, sure. Then this is a company that you can consider. But this is not something I want. Okay? Now, with that being said, for the color games, it's very clear here. I did not use, or rather, I only used one color for the color coding for the whole of today. Okay, so I will not have any trades that I will be looking at. Okay, and do we have any questions from our viewers before we move into the bankers portion that Terence will be covering here? Let's take a quick look here. We have a comment here which says, let's see, Honggan here says they'll sell whatever the company is overvalued or when the fundamental has changed. Sure. Honggan, the thing is that a lot of times, right, these fundamentals change, right? They change pretty fast. Like what happened last 2 weeks ago, in the Fastly situation, right? I will believe that a lot of the top investors actually were caught off guard. 30% overnight, 30% in one pre-market trading sessions, right? Is not something that you can respond to. You can only react to it. You can only sell first. You can only buy first, think later. You cannot make sense of it, right? There is no time for you to make sense of it. Okay? Right. So if you are the type that you can handle this snapshot reaction, sure, go for it. Okay, I can't. I really can't. I have to know what is within my parameters here. Now, Uncle Fu did mention something about Tencent. Then beneficiary of C listing will be Tencent, the largest shareholder with 39.7% share. And with Blue Dolphin Ventures, an organization set up by founder Forrest Lee, owning 15%. Lee himself has 20%, and CTO Gang Ye has 10%. Hanging Uncle Fu is giving us a profile in terms of the shareholders here, the majority shareholders who will be the beneficiaries when the company does get listed in certain sense, or when it actually got listed back then. Right, sure. So Uncle Fu also asked in terms of like Sea Ltd versus Huya, which is one of the company that we actually cover their competitor, Momo. Okay, so the question is Sea versus Huya, which is, I think Uncle Fu is asking in terms of what is our view here. Now, frankly, I did not have a quick look at Huya back then, or rather even now, but I would say that when I did the analysis for Momo back then, Momo's numbers for fundamentals and their competitors' numbers were not as inflated as the situation for C now. Okay, if I just do a direct comparison and I see which of these two companies am I more willing to park my funds on, just between A and B, if I really have to park my funds on, just because Sea Ltd has a more inflated numbers in terms of the price X ratios, I will just be more inclined to choose the other, just by that, by process of elimination. Okay, right. So I think that at the moment now we don't have any other questions. We'll go into the segment on technicals by Terence here. Meanwhile, if you have any questions, just continue to leave your questions and comments so that we can actually address them during the section here. Terence, your call here.
All right. Okay. Thank you very much, Jeremy. Thanks for the great analysis, everyone. If you enjoyed Jeremy's fundamental take on Sea Limited over here, can you just click on the like buttons to support him and let him know? Because I think Jeremy segments are always very, very quiet. Okay, you guys are probably listening attentively, but you need to let him know. You need to let him know that he's providing value for all of you. You need to keep him here, everyone. Keep him here. I can do this on my own. All right, make him feel love. All right, everyone, just click on the likes over here. All right, thank you. I think there's one new question over here. We'll get to that later. But let me get to my charts over here because I saw something very interesting. Give me a minute. All right, everyone, you should be seeing. I'm just going to pull both of us off the screen so you can see it a little bit bigger. Okay, all of you should be seeing my charts on. Thank you very much, Chao Soon. You should be seeing my charts on C. All right, SE. Now, so what I've drawn over here are some resistance level. Okay, now, so resistance that were broken out. Okay, that were broken out. Now, so what we have over here is the first resistance that was formed sometime in July. Okay, and then it was broken out by the beginning of August. So when it broke out over here, it came back, it tested it, all right, and then after that, because of earnings, it gapped higher, all right, and it gapped higher and challenged the next resistance itself, okay, the next resistance over here, all right, and then it broke it again, all right, so it started going higher, it formed this resistance over here, which is 163, okay, 163, okay, and then it fell from there, okay, it fell from there, it came back, it tested this one, it came back lower, okay, it waffled, okay, it basically channeled for a while, consolidation, okay, and then it resumed the next up move over here sometime in end of September, okay, so from end of September, we saw it going all the way up, okay, breaking out from the high, okay, which is 163, okay, and once it took it out, it hit a new high of 176, okay, 176, and now we are seeing it reverse. Okay, now, so from a daily perspective, okay, first I'm sharing with you from a daily standpoint, okay? Now, so from the daily chart over here, I actually see that there is a potential, okay, I'm just going to zoom in, okay? I actually see that there's a potential long opportunity, okay? We might be early, okay, but I see a potential long opportunity. But the only problem is this. The only problem is, okay, right now, it is also right on the brink of this support level. Okay, because once resistance is broken, it turns support. Now, so right now it's on the brink of this support level. If it does take it out, okay, if it does take it out over here, we can actually see it go back down to the next resistance support level, which is actually 147. So that's the problem because the stock right now is 163. Okay, from 163, it could free fall all the way to 147. That means that we could see if the next drop happens, it could fall 163, 147. That's about $15, $16. Okay, $15, $16 drop. Now, so we could see it drop $15, $16. So what's the upside then? The upside is if it does reverse and bounce from here, the first challenge it's going to see is at 177. Okay, so right now it's at about 163, so it could go up to about 167. So it's about $14. So your risk reward ratio is kind of like 1:1. Okay, now, so if you're trading stocks, this is what you have probably learned. Okay, if you're going long or short a stock, you need to really start paying attention to your risk reward. Okay, and most people will say that you want to risk $1 to make $2 at least. So if you look at this risk reward, it doesn't kind of make sense. Okay, so the only way you can make sense of this is perhaps to try and sell some options. Okay, so let's say if I want to go long, maybe I can sell some put options or something like that. Now, so then comes the next problem, because I actually went to the options and I went to take a look. So first, let's look at the weekly options. So the nearest one is probably next Friday. Okay, and immediately I see a problem because the bid and ask is actually very wide. Okay, and it makes sense because this is a new tech stock. So there probably isn't a lot of liquidity, more liquidity into the stocks, less into the options itself. So the bid ask actually makes it very difficult to negotiate out something. Okay, all right, now, so once I look at the bid ask, I'm not keen. So then I went a little bit further. I said, how about the monthly? Usually monthly volumes are a little bit better. So when I went to the monthly, I see the same problems. Okay, it's a little bit narrower, but still very wide. So which means if I place any trades via options, I'm still going to suffer a lot of slippages. Slippages means that, I may not get the best fill that I can get. So, from that standpoint, is a disadvantage to me. Okay, if I trade options, the risk reward doesn't make sense from the stock perspective. So this is where it starts to get difficult for me. Even if I want to be long on the short term, near term, it kind of makes it difficult because there is no viable vehicle that will allow me to do this. Okay, now, and of course, once it takes this out, if it, on Monday, we see a next red candle, it takes it out over here, it could fall very quickly to the next support level. Okay, why? Because it's done it many times. Okay, if I have to zoom it back out, we saw this. Okay, hit the resistance, after that, pump. Okay, within like 1, 2, 3, 4, all right, 4 days, and it's all the way down. Okay, hit this resistance, 1, 2, all right, and it's broken the support. So, it seems a little bit sluggish. I think that's what I'll say. Okay, now, and the next thing I want to do is to also expand it. Okay, because by expanding it, I want to show you some concerns that there are also if you want to go long. Because if you want to go long, you need to pay attention to the RSI. Why do I say the RSI? Because we have the stock hitting a higher high over here. Okay, and then a second time first time from here to here. Okay, and then the second one that I draw earlier. Okay, now, so the problem then is this. The problem then is, okay, from here to here, we can argue that, oh, Terence, we see strength. Okay, we see strength. That's okay, all right? But then the problem is for the second move over here, okay, there is actually a divergence. Okay, we're seeing a divergence, which means this price is going higher, all right? But the strength of the indicators are actually going lower. Yeah, okay, now, so to me, that's a problem, okay? And then the next one you have is probably here. Okay, it made a new high over here, all right? And then we had the same problem, all right? A divergence again. So it seems like this up move over here is happening with lower and lower momentum. Okay, now, yes, if you look at my indicators below, it seems like money flow is still going in, which means money is flowing into the stock. All right, now, and that's simply because for funds, right? You must understand, for funds, they invest in what's hot. Okay, because they need to chase performance, they need to report performance as well. So they need to go with stocks that are performing right now. They can't possibly be plowing their money into Intel, because some of you brought up Intel. Not because Intel is not a great company, but simply because Intel as a stock right now is underperforming. Okay, and fund managers have to report performance, and their performance are marked year to year. So if they're going to park their money in an underperforming stock for like 6 months, for like 8 months, right, then their results at the end of the year is probably not going to look too good. So this is one of the reasons why they will not plow huge loads of money into an underperforming stock like Intel, okay, until it starts to perform. Okay, that's when you see the flood of money going. Okay, and that's probably why you see, the flood of money going into companies like Sea Ltd. All right, why? Because once it starts performing over here, more money begets more money. Okay, but there is a concern that I have. The concern that I have is when I pull it out. Okay, now what do I mean by when I pull it out? Okay, so we went from daily. Now what I want to show you is the weekly. Okay, now, so looking at the weekly over here, I have a bigger concern. Okay, first I'm going to remove all my drawings. Okay, because otherwise you may not be able to see. Clear drawing set. Now, so the thing that I have right now is it seems to have hit a top last week, all right? And this week we have kind of like an indecision candle. Okay, now indecision candle is fine, all right? But if it does take out the last green week over here, all right, the low of the last green week, all right, we may start to see momentum selling off. Okay, why again? Because we actually have a negative, oops, sorry. Once again, we again start to see that divergence happening again. Yeah, okay, all right. Now, so as the stock goes higher, even from a week-to-week basis, all right, it seems like the strength is getting weaker. All right, so the only thing that's holding it up is basically the trend. The trend right now, please understand, is bullish. Okay, it's bullish because the MACD shows you, hey, the two moving averages lines are way above the zero line. That means the trend is very strong. Okay, the trend is very strong. The first thing that's going to happen is that, the secondary trend, which is the weaker one, may start to cut down. The histogram may start to turn red. Okay, but it will still take a lot for this two moving averages line to come all the way down to negative region. Okay, so these two lines are what we call the main trend. Okay, the main trend, which is usually going to take a lot more for it to change. Okay, so right now, if you're looking at a weekly chart, it still seems like it will take a lot for the tide to turn against a company like Sea Ltd, because once it broke up from this this resistance level over here, it never came back. All right, it never came back. Okay, but right now it's sitting at the top over there. Okay, we may have a resistance. If it turns around, all right, it may get ugly. Okay, it may get ugly because one, we have earnings around the corner. Okay, so earnings is not too far. So the last time earnings caused it to surge up. Okay, but if it still doesn't improve, okay, we may see the ladder. Okay, now, so this is why I say from, let's take a look at it. So earnings in March was about what, negative 53 cents, all right? And then in May, it lost even more money, it's 61 cents. And then in August, it lost even more, it's negative 68 cents. So what is going on? Because the environment favors the company, favors their business, they should be gaining more market share. And if they are reporting a gain in market share, then why are they losing money? Okay, one, they may be spending a lot just to build their infrastructure. Two, all right, it is a price war. That means, if you look at Amazon, you look at Lazada, you look at Shopee. Okay, now what's happening right now is a price war, right? They are doing all it takes to run all the promotions, to go all the cash vouchers, all the discount vouchers, just to woo shoppers. Okay, we can see this very evidently. We started from 9.9, then we had 10.10. Soon we're going to have 11.11, right? And then, of course, before we end the year, we're probably going to have 12.12. Yeah, okay, and that excludes, things like Boxing Day and, Christmas and stuff like that. Now, so it's going to be promotions galore, right, for shoppers. Okay, but for the platform-wise, okay, it may not be ringing the bells because they're probably still in the fight right now where, they're dumping money to try to get your dollar, okay, okay, because they want traffic. They're in the business of traffic right now. And, if they start to gain traffic, then the question is this. Is there loyalty? Okay, let me ask all of you this question. Maybe you can help me by responding in the chat box. Okay, as a shopper right now, do you think that you have a loyalty? Okay, do you have a loyalty? Okay, I'm just going to compare three platforms, okay, from a very local standpoint. Okay, we started off with Qoo10. Okay, right? And then Lazada came in. So Lazada started to bite into the shares of what Qoo10 was selling. Okay, and then we had Shopee. Shopee was probably the last one. And then we had Shopee who's biting into Lazada share as well as Qoo10 share. Okay, now does any of you have a loyalty when it comes to any of these platforms? Okay, if you have, type yes in the chat box. Okay, but if you're just for the dollar, that means as a shopper, dollar savings where I can get the best price at the best discount over here, can you just type the dollar sign instead? Okay, so it's either a yes if you have a platform loyalty, or a dollar sign if you're just out there for the best bargains as a shopper. Okay, let me know. Help me out over here. All right, yes, Honggan, you got it right. Okay, Jonathan, you got it right. Now, so there we have it. All right, so we started with Uncle Fu over here, which is not at all. Then we had Jonathan, which is no. We have Christy, which is just for the dollar, for the dollar, for the dollar, for the dollar. Now, then, let me ask you this question. If you are the business right now and you are very, very clear, you're very clear that all your shoppers are concerned about is the best bargains. Is the best bargains. So what are you consistently going to do? All right, what are you going to consistently do over here? You're probably going to consistently fight by being at the lowest price or the ones with the most coupons and the most discounts or the most prizes or the most promotions. And what does this mean then? It eats into your dollar. It eats into your dollar. Yeah, okay, all right. And on top of that, you have everything going for you. All right, in terms of the market, in terms of the conditions, people can't travel, people can't go out, people don't want to go out. All right, so people shop at home. Yeah, okay, all right. Now, so if you can't still find a way to improve, okay, don't even talk about turning profitable, to improve your loss situations, then I think you have a problem on it. Okay, then I think there's a problem on it because what you see right now is going to be probably a bubble. Okay, why a bubble? Because if you look at where the prices have gone, okay, that means from the beginning of the year, we had prices of Shopee going from like what? $70 all the way up to $160. That means the stock price doubled. Okay, but at the same time, it didn't improve. Financially, it didn't improve. Okay, all right, financially, it didn't improve. And I think from what Jeremy said, yes, it is a new company to the stock market, but it is not new in the business at all. Okay, it's not new when it comes to running their business at all. Yeah, okay, so are you sure you want to get in by paying such valuations when you know that the longer term performance, that means the weekly chart always trumps the daily chart. Likewise, the daily chart will trump your 1 hour chart, your 15-minute chart. Okay, so the longer term trend seems to say like, there's a turning point from top. Okay, while the daily trend shows like, yes, maybe you can capture a short, 2, 3, 4, 5 day bounce. Okay, but yet if you want to catch the bounce, the risk reward doesn't make sense when it comes to trading the stock. Okay, and then the options doesn't make it possible to structure any advantageous probabilistic trades at all. So to me, this is where I'm stumbling. Okay, I was actually looking at perhaps selling some put options on the long side, maybe for a quick bounce and then get out. But the options don't make it possible. And then I'm not going to jump in on a stock. Yeah, all right. Knowing that the stock can probably fall $5, $10 in a single day. No, I'm not going to get in on the stock. Yeah, okay. So no trade on this. Right? No trade. Not even as an investor. Okay, why not as an investor? Because it is peaking. And it's peaking with divergence on the indicators. So, there are many red flags around. I think there is too many red flags around. Yeah, all right. So I'm giving this a miss. All right, everyone. Back to you, Jeremy.
Right. Thank you, Terence. I think when you mentioned the part on the business time that is been in business, right? It just hit me that what I learned, what I hear from my professor, yeah, my professor was a doctor back in my uni days. So the subject back then was before that, let me just check. Any of our viewers are actually from Malaysia here? Can you just let me know? Just say hi. And then before that, I just want to make sure that I don't...
Just type MY.
Just type MY, yes. Just type MY.
But Jeremy,
I think
yeah. I just wanted to say, while there is a lot of things that you can analyze on the performance of the company from looking at the numbers, but a lot of times, there is always this moat part where it's very difficult to justify, and that's why anybody leaning towards the idea of how Buffett invests always stumbles on this moat concept. What's special about the company? So I also want to add in from my own standpoint. You realize, or many of my graduates will realize that I'm not very hardcore when it comes to fundamentals, which means I know and I see so many other value trainers who are analyzing stocks to the core. That means they're reading, right? But I tend to like to take more of what I call the helicopter view. Okay, a helicopter view from a very logical standpoint, because all you're trying to do is to form an opinion. Okay, and right now the problem is this: market is just plain right crazy. Market is just a bubble. So if you want to go and value any growth stock right now, I can only tell you one thing: it's a bubble. It's a bubble, but I don't know when it's going to burst. So a bubble can continue blowing up. So, they may continue to be correct for the near term, maybe even for the medium term. Okay, but sooner or later, we all know this: the market is a weighing machine. Okay, if you start letting the market go into that weighing machine mode and you have to knock out, okay, you're still not out, and pardon my language, it's going to be a bitch.
Yes.
Yeah, right. You're going to be cursing and swearing. So, as much as I like to sound all positive over here, but market is a bubble, right? If you really want to argue, you want to fight with me why it's not a bubble, right? I'm just gonna give one scenario. Okay, Eric may come hard on my heels on this. Okay, Eric, you are never cool for this. How do we say this? Never cool for this PE analysis over here. But PE works. All I'm going to say is PE works when it comes to fundamental, cash cow companies. That means companies that are already established. Okay, and all I'm going to say is this. Okay, I'm going to go back with Apple. Okay, so with Apple, let's go back to the analysis over here. Okay, now, so what Apple did was this. Apple made, where was this? Okay, I want to go annual. Okay, now, so in 2018, Apple made $3 a share. Okay, it made $3 a share. And then in 2019, it actually made less. Okay, it actually made less. Okay, but look what happened then. Okay, 2018. Okay, Apple was trading at what? After accounting for the split, about $50 In 2019, what happened? All right, it took off. Okay, it took off to $82 over here. And it made lesser money. It made lesser profits, and yet the stock took off. That's fine. But look at what happened after COVID. All right. Are you sure even if it makes the same amount of profits this year, that means the earnings per share stays the same, right? Does it justify over 2 times or double in the valuation? Yeah, all right. And you want to argue that this is not a bubble? All right. Now, if you're going to ask me why is it a bubble, very simple. All right. Because after COVID happened over here, the floodgates opened. All right. Cheap money came back in. All right. And cheap money flowed at a record pace. Why? Because they need to keep the economy strong. All right. So, this is all done by, I don't know whether you should put it on, I think it's Powell, right? I can't remember. The Federal Reserve Chief. All right. I don't know whether to put it on him or the pressure that Trump has given him. Okay. One, because no president wants to head into an election with a market that is all rate of C's. No, it's not going to happen. All right. So they're going to do whatever it takes to prop the market up until election is over. All right. Of course, it doesn't guarantee that they're going to win, but they're going to keep it up because that's going to keep their chances high. All right. For their battle, for their fight. But it's going to be like that. Okay. How is a company that is already established their market share? All right. There is no growth. There is no hyper growth. There's no hyper growth when it comes to the company or in terms of how much profits it can make. Right? Please understand this. Please understand it. How I've always told my students this: when you are making $4 million, if the next year you can record $1 billion, that's a hefty jump. That's a hefty jump. But when you're making that much money, like what Apple is already making right now, their profit figures are huge. Right? How much do you want to grow? Right? If you're making $4 billion a year, 4.01 billion is just a drop in the ocean. Yes, you made a lot more money, but it's still a drop in the ocean. People can't feel it. People can't touch it. All right? People don't feel anything to it. So your stocks should not be jumping. Should not be jumping like what Apple is showing you right now. All right. So to me, the extent is this: if you want to go out there and pay a 35 PE ratio for Apple, by all means go there. Okay, by all means go there. All right, but all I can say is if you want to look at this, you should not be overpaying. All right, if you want to compare to the S&P 500 over here, even that, I don't know if this is correct actually. This looks wrong. This looks wrong. Yeah, all right, okay, but you could go and Google out what's the PE ratio for the entire S&P index. Yeah, all right, but don't everyone. Okay, if you're playing with risk money, you're ready for quick cut losses, you can manage your emotions, by all means, go ahead and do it. Okay, but if you're investing, this is not the time to fall in love. This is not the time to fall in love. This is not the season for love. Yeah, all right, okay. I just hope I stressed that enough. Okay, Jeremy, back to you.
All right. I think at this point it's a bit challenging for our viewers here because they realize that why is it that the stock market is actually going up in terms of what we say as a bubble is actually because of the cheap money that the Federal Reserve has been printing easily. And the fact that if let's say, for example, they remain not invested, right, they're actually losing out in terms of the value of the same dollar goes down. And if they do put the money into the business, into the stock market too early without having much understanding of this business here, then they might go into the business that actually has the bubble. So we run into a catch-22 situation whereby you do also wrong, you don't do also wrong.
Yep.
I can understand that. I can understand where these issues are in terms of where our viewers might be feeling that I really need to move my funds somewhere. I really want to. Yeah, myself, I'm also having this problem, but I choose to wait. I choose to wait. Okay, because if I choose to wait, the money is still with me. I have the control. I have the rights to. But if I move it in and then it goes south, then it's gone. And it's never there. And it's I have to manage it differently really. Okay, going back to the
I think now is the time where you really have to pick and choose your battles. Really pick and choose your battles, because there are really great stocks out there that don't trade with that much volatility like what you see with Sea or what you see with Tesla, right? There are stocks that have a beta of 1 or less than 1 when they compare with the S&P 500, and they are actually hitting their support levels. So if you want to go long, look at small little wins over there from those stocks. All right, I'm not also saying investing in them for the long term. Why? Because Trump got exactly what he wanted. Right, the market was down like what 30%, right, in March. Right, it doesn't want to show a negative. All right, and it's got back to where it was before. So this is already a fantastic result. Right, if you want to weigh in terms of the stock market, how is his performance? Right, oh my God, this president did awesome. All right, a year where we are facing unprecedented situations, he has kept the stock market up. How great is that? You get what I mean? People's sentiments, not from a standpoint, people's sentiments. Right, he did well. How many presidents can boast such a result in the hardest time where the entire world is being hit? All right, the stock markets are hitting new highs. Tally that out. It can't be tallied up. And I'm only going to say one thing: if the Democrats win, all right, I think the first person to go is the federal chief. All right, and then comes the problem, because if he is lifted from his seat, whether the cheap money is going to continue is the next concern. And when the market never ever likes uncertainty. So when that happens, we're going to get volatility.
I think Terence, what you said.
We may start to see like the last election where Trump was a surprise win. Right, we may see the market do a quick sell-off, right, because it doesn't like the uncertainty, right? And then depending on the policies that the Democrats come in with, all right, then we start to see the stability, and then maybe it resumes. I don't know, but we're going to start to see a lot of volatility, right, after the elections. One, because even if Trump wins, we may start to see all the profit taking. Right, because everyone knows this, all the professionals knows this. The market is going to be kept up. Whatever it takes at whatever cost is going to be kept up until elections. But then after elections, what's going to happen? Is the support still going to be there? Is the algorithm still going to be there? People will start to think. And when people think, there comes the uncertainty. Right? So everybody will start to, maybe I should take a little bit of profit. Maybe I should take a little bit of profit. So a little here, a little there starts to accumulate, and everybody piles up. That's a power over there.
You know what, Terence, right? What you just said earlier, right? Actually struck an honor. I have not actually, I don't recall having said this in public so far. I think I did share this with my closest training partner that we kind of meet almost daily. What happened is, it is not a matter of whether the profit taking will come. To me, it's a matter of when it will come. You see, the thing is that I hope I'm stating the obvious for our viewers here, because it means that they already know. But for those of you who have not thought about this implication of this cheap money process here, then here's a simple explanation here. Now, you have to understand that, let's say, for example, your government makes money supply so easily accessible, right? In the long run, right, it's only gonna make your money less value. And in turn, what it means is going to be a case of inflation. And if, let's say, for example, it comes together a point whereby your economy activities is very, very low, like what we're seeing now, right? Then we are seeing a case of stagflation, stagnant economy plus inflation, which is very, very bad in terms of a economy. And it's something we only usually see in the textbook when it comes to me being an economics student when I was an undergraduate. Now, if let's say, for example, you did something that you can relate to in the Southeast Asia context, or especially if you're a Singaporean, just think of what happened to the banana dollar in the Japanese occupation back then. Right, these dollars, they basically had no value because they were so readily available. The money supply was so high. And then if let's say, for example, you think through again, right, it means to say that your money in the bank now is essentially worthless if I am trying to sell here. Right, so you see, the thing is that, yes, the stimulus package is going to drive out the market. Yes, it will. But in the long run, right, the economies, all the people who in the right frame of mind will tell you that they cannot sustain this because it will affect the overall competitiveness of the US companies when it comes to the overall balance of world powers, because US is the base currency for oil, one, and US is the base currency for a lot of governments' reserves too. Yeah, so there is a whole delicate balance in terms of ecosystems for money supply when it comes to this current situation, and it's just unfortunate that it's an election year that we're facing COVID-19 now.
Yep.
And I think that is why like our viewers are actually looking for Fastly and Sea Ltd when it comes to this last 2 weeks, because they want to park something and they choose to believe in companies that they want to see the explosive returns.
Yeah, but I think Jeremy, I think it's also fair for us to just note to all of them, because some of them are not from our community, and you'll start to realize that, you know, sometimes coming to my sessions and Jeremy's session over here, we may sound like, oh my God, we are like naysayers over here. We are always talking about the bad. Terence, you know, I have so many other sessions. They're all talking about these stuff. They're all, you know, trying to tell me all the positivities out there. But then you need someone who's going to bring out the entire picture, right? Yes, you can have a positive mindset, but you should also have a balanced mindset. All right. So, you know, like, I don't know who this is. It's a Facebook user, but I just want to say this. Do you ever think that investing, that means, you know, if you're thinking that stimulus will drive up the stock market and then you want to go long, do you ever think that trying to bet your money on a binary event is ever a good investment? All right, because you're banking on a stimulus. Let's say you want to buy a stock. You're banking on a stimulus driving the stock market up. Yes, it will, temporary. Okay, but then how much stimulus do you want to go? All right, it's like the boy crying wolf, you know. The first time he cries it, all right, people come. The second time he cries it, people come. All right, and then the third time, there's less people who come, and eventually nobody's going to come because everybody realizes what he does. So if the governments are going to keep going stimulus, right, sooner or later, people are going to realize that, hey, why you keep throwing money? Is it because the economy is not improving? Oh my goodness, how long has this been? How many packages have you given, and yet the economy is still not jumping up? Right? Just look at Japan. All right, just look at Japan. How low has interest rate been? All right, has they ever been turned around? They have never. All right, it's been more than 10 years and they're still going. All right, do you really want stimulus to lead to that? All right, because that's what Japan did. All right, that's what they did. They threw money after money after money. Yeah, all right, and it didn't work. Yeah, all right. Now, so, you know, I really hope I don't get flamed for this, but what right is there when, you know, we had Asian financial crisis where we had to suck our thumb and declare, you know, our crisis. But then now when the world is at problem, oh, you know, it's fine. I can print my money. The Americans can print their money. The Euros can print their money. All right. Why is there a double standard now?
Okay.
Yeah. All right. But, you know, as retail investors, we just got to protect ourselves. So you want to go long, that's fine. Make sure you're protected on the downside, because when the downside comes, it's too late. It's too late to do any hedging. It's too late to do any retrospective actions over here. It's too late. Now you want to get in, make sure you're balanced. So from option standpoint, sometimes we call it delta neutral, all right, where your entire portfolio has a delta of as close to zero as possible. Yeah, okay. That means it should not be lopsided. That means your portfolio should not all be on the long side. Because if you're long on the stock market and it turns around, you're in trouble. That's basically it. So take very, very measured be very selective. I think the right word right now is be very selective. So I'm going to place an end, and then Jeremy can probably put his close over here, because I just want to bring up this part. So, this part about, Chow over here, we were brought up Intel. Intel is profitable, right? But the only problem is this. The only problem is it just had an earnings disappointment. Okay, why? I don't know. Okay, why? I don't know. Yeah, okay. But, Intel, is it a great buy? The answer is yes, right? But not yet. Not yet. Okay, why not yet? Because it disappointed people. All right, and funds are not interested in buying an underperforming stock. So that means the heavy guns are not getting in. So if the heavy guns are not getting in, that means there may be a little bit more selling. What you want to see is, yes, it collapsed. All right, you want to see a consolidation before you get in. Because what if things get worse? That means it piles up on them. So you may end up, the danger of what people say, catching the falling knife. Okay, unless you're willing to own the stock. You must understand that. If you are trading options, if you are selling options, be more selective, be more patient. Okay, purely because of the market conditions. Okay, but if you're a willing owner of the stock, then by all means, yeah, okay, or if you're selling options on portfolios where you're ready to pick up the stock if things go wrong, then by all means. Yeah, okay, so a lot of times it's from what are you trying to plan, and then how you piece the puzzle together. Because when you do jigsaw puzzles, you need to have the end picture in mind. Otherwise, every piece is not going to make sense to you. Yeah, right. So when you build a portfolio, make sure it looks like that too. Right, that's my parting take over here. All right, Jeremy.
I would want to stretch it a little bit because this is the last of the October special. Just to touch on the modes section, the modes that we mentioned earlier. Now, I did read an article on GIC.
Jeremy.
GIC. Yeah.
Jeremy, sorry to cut in on you over here. I have another live segment starting at 4:30. All right, so I need to bounce off. I'll leave you to do the closing over here. All right, and then guys, next week, if we get back on Stock Nit-Picking together with Jeremy, it's back to us. We get to select. We get to choose. Yes. Don't worry, we will make sure we analyze and bring some great opportunities amidst, the closeness of elections over here. We try to do our best, all right, to highlight investable company. All right, so thank you very much for being here, everyone. It has been a very tight weekend for me. I hope you understand, but do give Jeremy a support. And I'll catch all of you next week as well. Yeah, all right. Jeremy, take your show.
Sure. Terence, you go ahead. Prepare for your session. Yeah. Okay. So I was reading an article in terms of GIC, right, and what they did in terms of how they invest the Singapore funds, right, to achieve a really respectable returns here. Well, I can't really remember the values in terms of its. I think it was a very quick read I did. But what it caught me was that how they actually did this trading style, which is called team-based investing. Essentially, what they did is they're looking out for teams, THEME, teams, whereby they would say that it could disrupt an existing world segment of behavior by any consumer, and then they look out for whether these teams could overlap with each other. And if let's say, for example, they could look at something that there is an opportunity whereby these teams, these opportunities, they overlap, and then they could put some funds in, then they will consider do so. I think that is a nutshell is what I gathered from the article here. So I hope that is something in the way you can use to examine whether this company that we're looking at has this thing called a moats, which is a unique selling point, unique USP, or for some businesses, business people who are saying USP, what is your USP? What is a unique selling point here? What is making you different from your competitors here? So the more teams that you can have in terms of this business, the more unique selling point, the more advantages you have, and especially in terms of barriers to entry, in terms of like unique skills that unique resources that you have owned, will actually set you aside compared to your competitors here. Like for example, if you look at Intel, you look at Qualcomm, things like that, they have very strong unique selling points like chipsets. You can't have that in a Chinese company for now. And like Qualcomm for now, you have the networks, which companies like Huawei actually playing very hard to catch up. So I think what I'm trying to say is that yes, our viewers are telling us with their polls and with their choices here that we want to have choices. We want to know where are we going to put our funds in, because we recognize that, hey, this inflation situation is going to happen soon. Okay. And there's only going to be one Jeremy and there's going to be one Terence. So we wouldn't be able to identify all of these opportunities for you. But if it helps, you can, on a broad stroke level, at least be able to identify the team-based investing that you can start to examine first. So you can slowly funnel down your choices. And then from there on, you slowly look for companies that may be worth your time to take a closer look. And if, let's say, there's anything interesting that catches your mind, catches your eye, do leave a comment in our community. We'd be happy to actually engage you and to see whether there's anything we can help you with that as well. We're always looking to see whether we can bring in more value for our participants in the community here. Yeah, I think that's what I wanted to share before I end of the October special for the IMP Stock Nit-Picking sessions. Right, so before I end off, do we have any comments or any questions from our viewers here? Right, a quick 2 minutes before I call it a day for October and head out for my evening appointment. Right, so if you also enjoyed the session today, do let me know. And also feedbacks are also welcome. So if you do like any segments or how we deliver it, so also can let us know as well. All right. Any takers? All right, thank you, Christine. Thank you, Jonathan. Thank you, Honggan. Thank you, Josephine. Thank you, Neri. Hi, Huin, you were asking on the good P ratio. I think we covered that earlier in the segment itself. You can run through the replay after the section is done. In essence, the summary is for me, my take is you don't rely on one factor. You try and use the other factors to look out for red flags for you to eliminate this company. Yep. So using the P ratio should be on a relative sense, compare it against the index, compare it against the 5-year average, compare it against the competitors here. All right. Where to get info on these team-based investments? Okay, actually, right. For example, if you really need to do any research, right, it's actually just Google. There is nothing unique, different that I'm doing. It's just as you do more, as you research more, you get more experience in how you can do it. How do you shortcut? How do you refine your search phrases, kind of thing, so that you can get your ideas faster. Yeah. It's not. I'm not reinventing the wheel here. So you can actually really Google that and see whether there's anything about team-based investing that helps you. I think another way you can get started is actually in Investopedia. I do believe that they have an article there that I read about it before. Yeah. Okay. All right. Yeah. Thank you, Terence. Thank you, Jaslyn. I think there's no question from here. So I am going to take back my weekend from you guys and I'm going to enjoy myself here. All right. So thank you, everybody. And we will see you again in November for the IMP Stock Nit-Picking with Terence and Jeremy. All right. Bye.